All right, hey everyone, it's Ron Toy. Let me make sure my mic's on. Ron Toy with the Ron Toy team at Cross Country Mortgage. Want to bring another live to you. Remember, if you miss it at the beginning, don't worry. I always record these, put it on my YouTube, usually within a couple of days. But man, markets having some great updates, and now this time I'm not going to jank around with my screen and do all that. I'm going to try to use the function where I pull up the information in the background, like a background screen. So let me do that. Beep, 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 boop, 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 boop. Done. So let's give you where the markets are at currently. Let's see. Nope, that's not the right size. There we go. So I'm going to get out of the way so that you can see the markets, and I'm going to go over it. So let me just step out so you can see this and screenshot if you want. So what I'm going to show you on this is, as you can see, the bond market's up 23 basis points, which means rates are coming down. And I'm going to go over why, because today was PPI report, that's Producer Price Index, and I'm going to go over some of that info. But as you can see, we have rebounded massive since the beginning of July. We're going to continue in this trend as inflation's coming down and all of that. But I want to show you this information. I usually flip my screen around, but I'm going to try it this way instead. But the things you want to pay attention to, let me see if I can point towards it. Right there, UMBS 30-year 5.5, that's the coupon. And so when you're shopping rates, you want to ask the lender that you're talking with, what is the bond market price and coupon that this rate is attached to? Because the bond market price is 100.62. Why this is so important, as you can see in the times right there, the 9:30, 10, 10:30, 11, 11:30. If you call me at one time and someone else at another, you might not be getting an apples to apples comparison because the bond market moves and fluctuates throughout the day. So I like to empower the people that I work with and my audience, the people who join my lives, to make a informed buying or refinancing decision, and also to know the questions to ask loan officers when they are shopping rates and mortgages, the questions to get to the bottom of it. So this is a super important, awesome day. Let me show you some more information, but here's the, again, so you can screenshot if you want. It's the current, most everyone in the mortgage business is trading off of that. There's other coupons, but this is the most common for right now. So let me show you some more information, because PPI came out today and it was better than expected. And this is exciting information. Let's pull that up. Boom. Let me see if I get up one that's a little bit smaller. There we go. So this is a little bit smaller. Go ahead and screenshot it. This is kind of a breakdown of the positive information that was come out from the PPI, Producer Price Index Report. And the next slide I'm going to show you is where to go to find it, because everyone has access to this information on the BLS website, bls.gov. And this is important because you can start to see where inflation, when everybody's talking points, where it's coming from, where it's coming down, all of that. But in essence, you can see right here as we go over these numbers, inflation was for PPI came in revised down to 2.2, which was beneath the expectations of 2.3. Fantastic. Core rate, it strips out food and energy, came in at 0, and it was expected to come in at 0.2%. So as you can see by this information, things are coming down, which is awesome. Is exactly what we wanted to see in order for interest rates to start coming down. Because in essence, what the Fed does, it helps to either tighten or loosen monetary policy in order to stimulate or cool the economy. So when inflation is high, what they attempt to do is raise the Fed fund rate, which is the intraday trading rate between banks. It impacts short-term loans, things like your car, credit card, things like personal loans. But it can also impact interest rates for mortgages, because in instance, it's a reflection of what's going on in the bond market. And when inflation's high, the Fed raises the Fed fund rate and interest rates are high because the 10-year treasury yield, there's a lot that goes into it. But I love sharing this information with the people that follow me or enjoy my lives, because I want you to be an informed consumer. Let me show you where to go to find the PPI report. Hey Rex, how's it going? Hopefully you're having a great day. I'm sharing about the PPI report that came out today, Producer Price Index. In essence, and also just so everybody knows, the reports are reflective of the month before. It replaces the So it's for July, and it replaces the July of 2023 numbers with July of 2024. So that's why when you look at my content for the beginning of the year, I told everybody watch for when we get into July, August, September, October, and through the end of the year, because all of those high inflation numbers that were like 7 and 8% would be replaced with the current information, which is bringing it down. Now, shelter and automobile insurance is some of the biggest impacts on why inflation is still where it's at right now. But we're getting a hold of that as well. So let me show you the next slide. Wrong button. There we go. Let's see. Is that going to fit the screen? Yes. So I highlighted it above so you can see the URL. I think that's the wizard term for it, but whatever the website link is. And I also highlighted it so you can see producer price index. Let me get out the way so you can screenshot it. So in producer price index for July of 2024, the reports are reflective of the month before. And it comes out every month, PPI, CPI, and PCE. So I want to show you some really important, the next slide I'm going to show you is going to be about the economic calendar for this week, because this is a very busy week, and why I'm going to be on here every single day, making sure to give you updates so that you are prepared. Because if you're a realtor, a lender, a person who's thinking about buying a home, or a person in a home currently and you have a mortgage, just be expecting to get a bunch of calls from lenders and mailers and advertisements trying to get you to refinance. You want to have a conversation with the loan officer who helped you closed your loan the first time if you had a good experience. If not, reach out to your local licensed residential mortgage loan officer. If you're here in Texas, love to help you. But make sure that it makes sense, because you can make it look like it makes sense on paper, but if they don't ask you the questions like how much longer do you plan on being in your home, you're looking to pay off debts, get more information than just, hey, I'll do this loan for you because I want to make a commission, they're going to be doing you a disservice. But let me show you the economic calendar for this week of reports that are coming. They're going to continue to see some positive impacts on the market as long as they come in the way we're expecting or better. Let me show you the next one. Oop. Economic calendar. I feel like this is more efficient than me spinning my camera around, but Vern, VERN, this is not the right size. Oh well, I messed it up. Technical difficulties, but it is what it is. I wish I could shrink the image. Wizardry, I don't know. But you can see today was important, producer price index, but tomorrow on Wednesday, CPI, which is an important measure of inflation that's coming out. Thursday, initial jobless claims, additional reports coming out that impact the bond market. And on Friday, we have building permits and housing starts. That's important because then that will give us a good projection about inventory. Because right now, home prices continue to go up because supply and demand. There's not enough homes to keep up with supply. I've shown you the slides yesterday on why that is the situation, because since 2015, you can track the data for housing formations versus housing completions. And housing formations have outpaced completion since 2015. When you have that situation, you're going to have not enough homes to keep up with demand. Also, when you have private equity, hedge funds, and corporations buying up the inventory, they don't turn properties like a normal family. Because if you buy your first home, typically you're in that home 3 to 6 years. And so with hedge funds and investors, they're not buying to flip or to sell every couple of years. They're buying it to hold. So now those regular homes that were coming to the market aren't happening. And because we have the most equity we've seen in homes in at least the last 60 to 70 years, the average equity position is over 60%. That means defaults and foreclosures are not going to be enough to keep up with demand that sometimes in the past was an avenue people could use to get property. But there's still, this is why I like to do this, is that there's still options and hope and opportunities to take advantage of the market before it gets really crazy towards the end of the year. Because for every 1 point drop in rate brings another 2 to 3 million buyers back to the market. Let me pull up the chart again one more time, just so people can see it in case they're just coming in. I think this one is the one that fit. Perfect. So this is the chart. And as you can see, massive rebounds since July, and we're over 250 basis points improvement. If the reports come out well this week, we're going to see potentially go above that ceiling of resistance right there at 101, and that would be huge. Just stay tuned, especially, and then in September, if the Fed cuts the Fed fund rate, it's going to be awesome. But that's why you need to buy what you can comfortably afford now. And there's a lot of advertisements and people in the media that are talking about home ownership and making false information claims that home prices are going to magically drop. And I'm just going to cover it again, even though I covered it yesterday, about why home prices are not going to drop. And here, let's show you. Because in our nation's history, I've shared this several times, there's only been a select few where home prices fell. And I think this one will fit. Now, let me try another one for you guys. Does that fit? It's not that great. Come on now. I got to figure out how to get the sizing right. This one be better? Nope. One of these days, technology won't beat my butt like a drum. Here's the home price appreciation rate since 1942. Screenshot that. Keep in mind that we've been through wars, recessions, everything. Think of 56 gas shortages, high 20% interest rates in the 80s. Look what home prices did in the 80s. Why this is important for people that are thinking about buying and why I encourage people to buy what they can comfortably afford is, as you can see, the appreciation rates. But what's great is what investors call cash on cash return. So if you buy 10,000, or if you have 10,000 shares or spend $10,000 getting some stocks, right? And those stocks go up 10%. That means you made $1,000, and that's great. Most investors want to see at least a 10% rate of return. The great thing is with buying a property, if you use that same $10,000 to get into a home, and let's call it a $200,000 house, and that house goes up 10%, which we see it all the time in our nation's history where home prices go up above that. The appreciation rate is based on the total value of the property. So that $200,000 is now worth $220,000. So your cash on cash return is significantly higher because you just made your $10,000 back plus an extra $10,000. And this doesn't even count in the tax benefits, the principal balance reduction that you get by making your payment. So this is why investors are consuming property, because you're making your money that you're investing based off the total balance, not just the stock prices that you're buying. So this is huge. And even Warren Buffett said if he could, he'd buy up 10, 20,000 homes and sit on them, but it's just the management that would take so much time because of how, get mortgages, leverage the debt. Because when you buy a home, in essence, you're protecting yourself from future inflation. You're buying it at today's prices. And, a lot of people talked about, well, my parents bought a house in the 80s for 100 and something thousand. Well, when interest rates are 20% versus, right now where they're in the sixes, that's about equivalent to about a $300,000 home. So while it was nice to have lower prices back then, the higher interest rates kind of balance that out. But it's always a good time to buy. It's just that some people over leverage themselves trying to impress people that don't matter, and then they fall into financial ruin. And so that's why I like to be on here giving you important, sound information for you to go back to your loan officer and check with your financial advisor, your CPA, say, hey, I saw this information from a guy on TikTok and I want to make sure it checks out. But also fact check me, go to BLS, go to Case-Shiller, look up the data. You can pull it. That's what's so great about this is you can pull the data yourself to check it. Because I just did a thing on my channel yesterday from CNN where they're talking about the largest shakeup to the real estate market in 100 years, which is they're talking about the NAR settlement that takes effect. I think it's August 17th. In essence, what that's doing is telling the listing agents you can't put the commission split on the MLS website. And they're encouraging the listing agent to do a better job communicating with the client about the commissions that the client is willing to pay, and then having that information, then the buyer's agent having a better conversation, which has always been the case. That's why this is shocking to me. Good agents have always brought the buyer rep agreement to their meeting and initial consultation with a buyer and explained the process. Only people shocked by this are people not in the industry or people that are not skilled to be able to communicate to their clients. And so it's not going to be the shakeup that everybody thinks. And they think that this move is going to help bring prices down by bringing commissions down. But in essence, again, it's not going to check out, because if you've ever bought or sold a home you know that, especially if you sold a home, you want as many people making offers on that property as possible. And so a way to do that is to work with a good realtor who's going to walk you through the process and explain to you what they do to earn their commission. Making sure it's listed on the MLS, because if you're not a realtor, you can't just put your home there. So you want as many eyes to see it. Having that access is huge. Having a realtor database that then is also going to be able to help market, take photos, give you advice and guidance on how to get a home inspection, what all that means, because most people, they buy maybe 2 to 3 homes their entire life. I have helped in the last 10 years over 2,000 people with their home investment journey. So I've seen a lot. And realtors are in the same boat. They're out here looking at homes every single day, doing tours. So that experience is valuable. And it's going to help because look at what home prices did in 2019, 2020, 2021. 2021, home prices went up 19%. 2022, 6. 2023, the data came out, home prices appreciated between 5 and 7%. Right now, we're on trend to do 6 to 7% appreciation in 2024. So people are like, oh, home prices are going to come down. No, they're not. Prices have had some reductions because properties have sat, because there's some volatility. But when you look at home prices they bought in 2021 for X amount of dollars and it went up 30 to 50%, of course, if they can take 20 grand off to move the property, that's fine. But that doesn't mean the home isn't worth the other amount. They're just trying to move a property. It's business. And so this is common in this time period, but that's why it's so important to buy what you can comfortably afford now. Because like I said, every 1 point drop in rate brings another 2 to 3 million buyers back to the market, which means increased demand. So then sellers can be a little bit more picky and choosy. So they won't be doing the reductions. They won't do as many seller credits. Now you can still negotiate. Sometimes they will. But collectively, in averages, a lot of those things fall away. Other part that falls away when there's more competition is seller paying the title policy. And I know some people as sellers are like, well, I don't want to pay all this. Think about it this way too. If you bought a $300,000 house in, let's say, 2015, and now your home price has gone up 75%, your home is now worth about $700,000 to $800,000. So when you sell that home, you're going to profit $500,000, $600,000. So if you got to pay out 20 grand in fees and commissions or whatever to make 600 grand, like that's an easy no-brainer to me. And so that's where I feel like this conversation is interesting. But let me show you this chart again. And I have a better one. I just don't know how to shrink it. But home price appreciation since 1942. Again, most people think that, oh, we're going to see home prices drop because they happened in 2007 through 2011. But I've shown you the charts yesterday on why that happened. In 2006, we had the most homes built ever in our history, and there was over 4 million homes available. If you look back 33 years from then, in 1976, there was a huge drop in population. And so when you take into the drop in population, and there's 11 million less people born in Gen X versus the baby boomer generation, you have a recipe for disaster. And they kept overbuilding because there was false demand because of the lax lending guidelines. Back then, if you could fog a mirror, you could get a loan. There was stated income where you could just say you made X amount of dollars and they'd give you a loan off of it. Balloon mortgages. It was a disaster. And people were getting 5, 6, 7 houses on $50,000, $80,000, $100,000 a year income because they said they made significantly more, thinking that, oh, the market's going to continue to grow like crazy, so I can refinance later. And then they got hit with the balloons, and it was a recipe for disaster. That will never happen again because we've tightened up lending guidelines, and the banks aren't self-regulated anymore. Now, there are people that are pushing to try to get some of those protections removed, kind of like what happened when some of the Dodd-Frank protections went away in 2017, allowing private equities to use their own funds to invest in properties again, which is backwards. But we have to define reality the way it is, not the way we hope it to be. We can strive and put things in place to achieve our goals, but right now, home prices are going to go crazy as rates continue to drop. So buy what you can comfortably afford. Don't try to impress neighbors or impress people who don't give a crap about you. Do what's best for your long-term goals. Find out what you want. If you want passive income of X, great. How many doors does that mean? Doors are properties. If you buy a fourplex, that's 4 doors. Maybe you're faster to get to your passive income goal by buying fourplexes and duplexes, living in one, renting out the others, staying in it 12 months, and then repeating the process again, buying another duplex or fourplex, stay at 12, 24 months, buy another duplex, fourplex, staying at 12, 24 months. In 3 to 5 years, you've gotten enough property to have great passive income and be able to be free. That's my goal in this, is to help people be free so they can do the stuff they like instead of being a slave to their job and debt servicing. If you want a consultation, click on the link in my bio and on my page, schedule a time to talk. I'm here to help make sure that everything we do aligns with your current and long-term financial goals. Talk to you soon.